B Prasanna joining us now, Group Head, Global Markets, Sales, Trading and Research at ICICI Bank. Prasanna, thanks so much for being with us this morning. Let's first, get a sense from you, with the way that that growth continues to sort of, fluctuate at lower levels. What's the impact you see continuing when it comes to yields currently and the outlook on growth?
So I think we have penciled in a growth of 5% for FY20 and a mild revival for FY21 at around 5.7%. So we did see some kind of green shoots happening in the economy, with some of the high frequency indicators actually getting better in the month of December and some in the month of January as well. But then you would realize that these were actually kind of a lag indicator, in the sense that the full impact of the virus outbreak at that time had still not happened. So one guesses that sentiment indicators would obviously now will have to be looked at closely, because though India is not directly linked in terms of value chain, in terms of the trade chain, as well as in terms of the number of tourists and other people related connections with China, the fact is that the sentiment also will reflect about what's happening on the global economy and in the global markets. So we'll have to have a close watch on that. But so we have still not downgraded our economy from that perspective. We still have calling for a 5.7% kind of growth for the next year, FY21.
Are you undermining the importance of Corona and what that could do to the global economy, and in turn India, as it is, exports are down? And in a slowing down world, if economies are suffering, then it will start hitting us. Everybody is acknowledging the impact of coronavirus, and India, somehow we've not heard from any official administrator or government talking about the impact.
So Nikunj, I'm not really undermining it. All I'm saying is that we need further data before we really start actually downgrading the data. So my guess right now would be to say that we do have put out a 5.7%, which is already a very reasonable number for next year. All we are saying is that there could be a downside risk for want of further data. And once the data comes in, and once we figure out that the value chains are getting impacted a little bit more, then we would have to take a revised call. Nikunj, you should also realize that there are a lot of industries which could possibly try to, spin this story around in a positive manner, in the sense that demand which is earlier going to some other countries could potentially be taken by the Indian industries in terms of capturing export markets. So the net, the impact is still not clear. What I can clearly say is that from a services perspective, for example, we are not really greatly integrated with the rest of the Chinese and the Chinese travelers, with them coming in much lesser than what they are in the rest of the economies, especially in Southeast Asia. So the fact of life right now is that India is in a region which is terribly exposed to this virus because of the closeness between China and the rest of the countries. But India, being relatively delinked, is not going to be as worse impacted as the rest. So I'm not necessarily saying that it's going to be positive, but I think the negative impact is still not very clear. So we would watch for further data before we take a call on that. But at 5.7%, you would realize that we are already, very reasonable in our growth projection.
Fair point. The 10-year paper, we both know, is at a multi-week or multi-month low. Given that Reserve Bank of India latest data is indicating that the private bank credit growth has come down to 12%, and for PSUs it's only 4 to 5%, and we know that liquidity is back in the system. So what kind of scenario are we looking at? Liquidity deficiency is over, surplus liquidity is there, and demand is not making a comeback.
So a lot of things have gone in favor of the bond markets and the 10-year yields in the last 1 month. It started with the budget, where they had actually opened it out, or planning to open it out to global investors. So from a capital perspective, we were going to expect a lot more capital inflows coming into bonds. I'm referring to the index inclusion and the fact that they are actually planning to make bonds a part of the ICSD framework, which actually makes it eligible for trading by non-resident investors, not just foreign portfolio investors. investors. The second part of it is, of course, the monetary policy, which was a master stroke in terms of giving liquidity in the form of the LTRO operations. And also, you would remember before the monetary policy itself, RBI had started the operation twist, where they were actually buying the long end. So they were buying the long end and they were selling the short end, and the LTRO actually comes and addresses the fact that the short-term yields could have potentially gone up. So net-net, it's a very positive kind of a framework for bonds purely from a demand-supply perspective, because RBI is clear in its attempt to, kind of make the easing happen through non-repo rate measures. Also the fact remains that repo rate per se, there seems to be a little scope for RBI to cut at this point of time, and the fact that inflation is possibly going to come down only in Q3 or Q4 of this year makes that a possibility of a cut, high probability of a cut only happening in somewhere around June or August policy. So from that perspective, I think the demand and supply for bonds are positive, and that's the reason you have seen yields coming down post policy.
Okay, fair enough. On the trajectory going forward as well, we talked about that, but can we anticipate anything else, from the RBI in terms of ammunition? The central banks globally have also been pumping liquidity, to counter slowing growth. But where does India really stand in the overall context? And, can we anticipate any higher investment in the economy? What's the outlook going forward?
So I think India, the central bank in India has actually adopted a couple of measures which have so far not been adopted by the Indian central bank, at least. These are things like LTRO as well as the Operation Twist, which have been actually the ideas which are actually Western ideas which we have borrowed from, but nevertheless I think finds a place in the current monetary policy requirement. So from that perspective, I think the infusion of liquidity has been a positive, and RBI has also given the comfort to the markets and to the economy that they are going to pull in much more liquidity and give the comfort to the banks that funding is not going to be of concern. So the fact of the matter is that what liquidity can do is to bring yields lower, or can because of the borrowing program, for example, because of the next year's borrowing program, suppose yields were to go up, it will ensure that the RBI's operations will ensure that it actually keep a lid on yields going up. So from that perspective, it will be an easy environment from a bond market perspective, not too negative. And what it does to the investment needs of the economy is you only have to assume that the flush of liquidity which is available will make the cost of capital lower, and will help enabling, and the enabling environment will actually make corporates invest a little bit more. So I think this government is definitely betting on an investment-led revival, and they have done everything possible to take the enabling environment positive. Because there is the degrees of freedom with respect to direct pump priming of the economy through fiscal was really not available for the government, and the government took a very responsible call that they wouldn't go through that route, and hence they are making the enabling environment a little bit more positive and hoping that the investment-led revival would come back. So in this context, it would be interesting to also note that once the virus effect fades, the revival in the global economy, especially in the Chinese economy, could actually be a V-shaped recovery, because there will be a lot of fiscal spending that the Chinese government would put into the country, and hence it will be an interesting place for us to keep a watch out for, especially as to when the risk of the virus is actually coming down, and when the V-shaped economy recovery takes place in the global arena.
Just an outlook from you also on long-term, on the term spreads, given that we're seeing a benefit on the short end yield curve, but the long end still facing some challenges from government borrowing. What's your view on spreads going forward?
So that's a very interesting question, Abha. So what really happens is that the spread of the 10-year bond yield over the repo rate has been pretty much on the higher side, considering that we are in an easy monetary policy environment. And what RBI has done clearly is to target the term spreads, because if they can really get the 5-year and the 10-year bond yields to come down, especially the 5-year bond yields to come down, that will have a greater impact on the corporate bond spreads, and hence the corporate yields coming down will benefit the corporates and hence the real economy. So I think RBI has gone ahead with the LTRO and the operation, actually especially the LTRO, with the respect to bring down the short-term yields, and hence the term spreads from the repo rate to the the 5-year bond yield, I think we do expect it to keep coming down. It's already down by around 25 basis points post policy. We expect it to come down a little bit more. The 10-year is a little bit more tricky, because as the short end yield comes down, it will have a natural effect of bringing down the yields on the 10-year. But like you rightly said, on the other hand, it also has the negative effect, so-called negative effect from a higher borrowing program in the 10-year, which will start in April. So these are two opposing factors. But to prevent the uptick in yields on the 10-year, RBI also has another weapon up its sleeve, which is the Operation Twist. So it really depends upon when RBI is going to come and come out with that measure. And the market knows that they can't really go short too much on the 10-year, because any point of time if the Operation Twist comes in, then it's possible that the 10-year yields will come down. So I do expect the term spreads from the 10-year to the repo rate to actually be in a range of 125 basis points to 150 basis points, which is really like saying that the yield will be in a range of 630 to 660 kind of range till around April.
Thanks for joining us, Prasanna. Good chatting with you, as always.